Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Investing is partly about finding great companies that we can buy, but it's also about avoiding companies that are a disaster in the making. And there are three that I think are really in trouble long term. That's what I'm going to get into today. My name is Travis Holliam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to get right into the first stock, which is ChargePoint. If you aren't too familiar with ChargePoint, this is an electric vehicle charging company. They make chargers and they also have a network of chargers where they sell electricity to users. The idea would be to be something like a gas station of the future. The challenge is they're selling a commodity, electricity, that is readily available with a standardized plug. So there's really no difference between their charging network or their chargers and any other company. And you're really seeing that play out in the company's financial results. If you just look at the stock price, this was really a pandemic stock. Just jumped like crazy in late 2020, early 2021, has just been on a downward slide since then, but still has a market cap of about $2 billion. So still a fairly sizable company. But I want to get to some of the metrics that investors should really be looking at, because this is what's important for a company like ChargePoint. How much revenue are you generating? How much net income are you generating? You can see that revenue is growing very, very nicely. Now nearly $6 million in revenue. That's up from under $100 million in 2019. But you can see that losses are growing as the company is growing. What's the reason for that? Well, gross profit margins are not all that strong and they're not getting better. In fact, they're actually getting worse, about 15%. So that is not enough to make a profitable business. And that results in what we see here, which is free cash flow being not only negative, but just massively negative, $344 million in negative free cash flow over the past year. So the operating trends are just not good for ChargePoint. Doesn't seem to be anything that's going to change that in the near future. Like I said, they're selling a commodity through a commodity plug. And the network itself, I don't see how it differentiates itself. And the EV charging market just is not sizable enough today to have a big profitable business that's worth about $2 billion. The second stock that I want to cover, and I'll cover the same components, is Plug Power. Plug Power was another pandemic darling in late 2020, early 2021. Stock shot up to over $60 per share. Now it's down to about $8 per share. Still has a market cap of about $5 billion, but debt is actually up there at about $1 billion as well. But let's look at those operating trends because they aren't any better than ChargePoint. Once again, I'll start with revenue. You can see that revenue growth is just tremendous. This is not a company that has trouble growing revenue. It does have trouble turning that revenue into net income. You can see that the net loss is almost as much as the company's generating in revenue. Astounding that they've lost over $800 million in the past year. Free cash flow was actually a negative $1.7 billion in the past year. And here's the one that is just crazy. Gross profit margin, negative 27%. So none of these metrics are any good for Plug Power. I don't see any evidence. This is not a new company. This is not a startup. This is not a company that's doing technology that's brand new. It is decades old at this point, and it has proven time and time again that management does not know how to make money, but they continue to issue shares and continue to fund operations through selling stock to shareholders. But long term, that's a really bad strategy. That's why I would absolutely avoid this stock. The third one may be a little bit surprising, and that is Paramount Global. This is a media company. It used to be really big when cable television was bigger, owned properties like MTV, Comedy Central. But now the company is in a really tough strategic position. They have some of the weaker content assets in streaming right now, so don't have a big user base or ability to grow a big user base like a Netflix or a Disney. They also have less pricing power, so you just don't have as much revenue coming in the door, and you don't have the same power as you did during the cable bundle days where a single really good channel could actually float a very good business. So they're burning money by operating the streaming service that they have, and they just don't have the money to do that. Total debt, $17 billion, market cap is $9 billion. So a very highly leveraged company. And let's look at these operating metrics because they're not looking all that good for Paramount Global. Unlike ChargePoint and Plug Power, this is not a high growth company. Rather, it's a pretty stagnant company. We are starting to see them lose money from a growth perspective from the cable bundle, but this is something that's common with all of these stocks. Paramount Global is losing money and is losing money in a big way. This is in large part because of the investment in the streaming service that's not going particularly well from a net income perspective. And free cash flow is also trending in the wrong direction. Negative free cash flow of over $1 billion in the last quarter. And just to show the gross margin number as well, gross margin has gone from over 40% on a pretty consistent basis to 33% in the past year. For Paramount Global, I think the challenge is that the cable bundle is dying. That was really the cash cow that drove them and a lot of the other media companies. And now we're seeing they don't have enough power to be a big player in streaming. So they're going to be likely one of the companies that's left out. They could sell the content they have or license that to other streaming providers, but that's not what they're doing with their content right now. They want to be a streaming company. I just don't see a world in which they are one of the top 2 or 3 streaming companies. So very tough position for them. The companies that I would absolutely avoid today: ChargePoint, Plug Power, and Paramount Global. What do you think about those 3? Do you have a different opinion? You'll leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.